All right, let's go ahead and get started with some fairly simple introductory level concept questions related to inventory. Little matching exercise right up here, and it says match each description to the appropriate document used for inventory control. So the first one says last document in the chain, and it is used to compare all three for accuracy. Okay. So let's think about the process here that we're going to go through. We are going to determine, regardless of what type of inventory system we're using, whether it's a perpetual inventory system or a periodic inventory system, we're going to determine what we need, and we're going to begin that. And so once we do that, whether it's a manual process or an automated process, we're going to put together a purchase order. A purchase order is always going to be first. Once it is approved, we'll at some point get the merchandise, and we'll have a receiving report, and then we're going to get the vendor's invoice. We're not going to get the vendor's invoice when we get the merchandise, because there's a serious problem there if we do, related to internal controls. Okay, so what we do, we have our purchase order first, then we receive the merchandise, and we fill out a receiving report that simply says, hey, this is what we got. Okay, this is what we received. Then our vendor is going to send us separately a vendor's invoice. Okay, and so what we're going to do is we're going to take that vendor's invoice and we're going to compare it to both of these reports here, because we want to make sure of a couple of things. Number one, what's on the vendor's invoice is what we actually received. Now that's very, very important. We don't want to pay for 12 of something on the invoice if we only received 10 of something, right? Right. But the other thing that we want to do is we want to compare all three of these documents, and again, the vendor's invoice is going to be our answer here. We want to compare the vendor's invoice also to the purchase order, because, hey, you know what? Maybe there's 12 of them on the vendor's invoice, and we received 12 of them, but what if we only ordered 5? Or what, that means the vendor is sending out more inventory than what we actually ordered. Conversely, what if the vendor's invoice has 12, but we ordered 30? And this is a recurring issue. We may have an issue with the quality of the vendor. Okay, so B is the first answer. Last document used in the chain is the vendor's invoice. Authorizes the purchase of inventory from an approved vendor. Hopefully we can put together that a purchase order is used to purchase inventory. So C. That leaves only one choice for the last one. It says establishes an initial record of the receipt of inventory. These two words are related, so that is the receiving report. Okay. Next one is a true-false. It says a subsidiary inventory ledger can be an aid in maintaining inventory levels at their proper levels. Okay. This is a true statement. I want you to think about this. The subsidiary ledger is most beneficial in what is called a perpetual inventory system. And so let's say that we have an item that we sell 100 units a month on it. And we understand that just when we go to reorder that item, that we're not going to order it today and get it today. So there's a little bit of what's called lead time involved, right? It's kind of the same way where hopefully if you're getting low on eggs, you go buy another dozen eggs, when you're at a couple of eggs, not whenever you fully run out. So what this subsidiary ledger does is it says, okay, we sell about 100 of these a month, but we kind of want to have a minimum of 40 of these at a time. So we can look at our subsidiary ledger and we can say, we're selling 100 of these, we have 38. We better order some more. So that's how it helps maintain inventory levels at the quantity desired. Taking a physical count of inventory is not necessary when a periodic inventory system is used. Well, it's absolutely necessary when a periodic system is used, because if we don't take a physical count of the inventory under a periodic system, we can't determine ending inventory and we can't determine cost of goods sold, because under a periodic system we're only doing this once per period. Should be done near year end. Well, that sounds right. Let's see what else we have. Has no internal control relevance. Taking inventory, regardless of whether it's a perpetual or periodic inventory system, helps us know that what we're showing on the books, especially under perpetual inventory system, is what we have. Under periodic system, we have to be a little bit more in tune with how inventory moves and have kind of a ballpark idea of what we should have based on sales. But taking a physical inventory is done specifically. The primary purpose of it is internal control. A secondary benefit is that we're able to calculate cost of goods sold and ending inventory more precisely. And then finally, it is not necessary when a perpetual inventory system is used. Well, I just blew that up. So our best answer should be done near year end. Last day of the year, early morning next after, but definitely around year end. When using the FIFO inventory costing method, the most recent costs are assigned to cost of goods sold. This is a backward statement, making it false. When using FIFO inventory, the oldest costs are assigned to cost of goods sold. First in are the oldest inventory items, not the most recent. So this statement would be true if it said LIFO, but it says FIFO, so it's wrong. Okay. During periods of increasing costs, an advantage of the LIFO inventory cost method is that it matches more recent costs against current revenues. I'll give you a second to think about that. We know that the revenues are current because we just got them, right? So it's saying that an advantage of LIFO inventory cost method is that it matches more recent costs against current revenues. Well, this is always an advantage of LIFO. Your textbook may tell you that FIFO has the advantage has a balance sheet advantage in that the value of ending inventory using FIFO on the balance sheet is more reflective of current costs, and that's true. But LIFO actually has an income statement advantage, and this is it. It matches the most recent costs against current revenues. So this is absolutely a true statement. All right. It says here the weighted average cost method will always yield results between FIFO and LIFO. We have an example of this maybe in the very next handout. I can't remember. I think it is actually handout video. And you're going to find that this is absolutely a true statement. All right, during times of rising prices, which of the following is not an accurate statement? Okay. So, first one says, average costing will yield results that are between those FIFO and LIFO. We just said that was true right here. So if that's true, that's not the answer that we want. in a period during times of rising prices, LIFO will result in higher cost of goods sold than FIFO. Absolutely, that's true. Because the prices are going up, and LIFO expenses the most recent purchases, so they're expensing these higher priced items, therefore cost of goods sold is higher. And because that's a true statement, it's not our answer. FIFO will result in a higher net income than LIFO. Okay? This is going to end up being the correct answer, and I want you to understand why. If, FIFO always expenses the oldest purchases. Well, in this case, because prices are going up, the inventory items that are being expensed to cost of goods sold are those at the lower prices before the rising prices hit. Therefore, each item that we're selling, that we're expensing to cost of goods sold, is lower. That makes net income higher because the cost of goods sold is less. And then D, LIFO will result in higher income taxes than FIFO. Well, let's think about this. LIFO results in higher cost of goods sold. If we have higher cost of goods sold, we have lower net income or lower income. And as you probably know, just from your own personal income tax, if you've ever filed an income tax return, the less you make, the less tax you're responsible for. So in a period of rising prices, LIFO would result in lower income taxes because it's going to result in higher cost of goods sold and lower net income. This choice, thankfully, is wrong because for a beginning class, it's somewhat conceptual. All right, that's it for this video. We'll get another one up shortly.